Happy New Year. It's 2026, and I'm going to talk today about the all-weather strategy, performance, trying to understand what's going on, what's working, what's not working, talk about performance in December, and of course, take your questions. So I hope that you've had a wonderful New Year, and I had a great time relaxing in Bangkok, doing some work, of course. I never stop working. There's me at my office at home, and always trying to think about how we can do better in our strategies. And so we're working on that all the time. So welcome everybody here, and make sure to say hi and all of that. And we'll see you in the comment section. And if you have questions, leave them in the comment sections. So I see Sakaret says, Happy New Year, Krap Ajan Andrew. Happy New Year, indeed. I have a really good feeling about 2026. I think it's going to be a great year. Lots of good things coming. And so I really wish you the best blessings. I'm in a line group with some people that I know, and one guy said it's going to be a terrible year and everything's bad, and I thought no, I don't agree with that. I think it's going to be a great year, and we can make it a great year. Even when trouble comes to us, we can still make it a great year. So let me get started into this presentation here. I'm going to be talking about the performance for December of last year. So first thing at Phenomena, more than 7,000 followers now have entrusted our strategies with about 7 billion baht. It's a responsibility that we take very seriously. We've also launched a new AWS RMF, which has already attracted about 84 million since its inception, just late last year, 17th of December, 2025. If you want to learn more about that, just reach out to your advisor or check it out on the platform. The RMF is based on the same all-weather strategy that's available at Phenomena, but executed through U.S.-listed ETFs. And Stotz Investment Research is a research provider to Thales. We provide the research, and then they make the ultimate decisions. Now, remember to ask questions in the chat. I love to get your questions. It helps me also sharpen my game. And for those people that are in Bangkok, let's meet. I'm going to be doing an event next Tuesday, January 13th. And this is for business owners and leaders. This is called Double Your Profit by Understanding Your Firm's Finances. Find out why your profits lag and how to fix your profits fast. It's a free event. It's at AIT at the Asok intersection. Just scan the QR code or go to astotz.com/events and make sure you sign up to reserve your seat. Now, our allocation strategies are global, long-term, and diversified. These are three core principles that I believe in and we implement. Remember why we're here, to build wealth over the long term. I wanted to talk just for a moment about a lesson I learned from my mother. And this lesson basically is that you can get anywhere if you just keep walking. When I go traveling with my mom, for instance, we went to Nan province late last year, and we got off of the car at the airport, and we checked in, and then we walked to the gate. The gate was far away. It's about 2 kilometers walk. But what I did with my mom is I always say, let's walk. And we walk. We get there early enough that there's plenty of time. And one of the big lessons I've learned is that you can get anywhere if you just keep walking. Today, I had a meeting at Sasin. I went to Sasin, got dropped off. My mom took the car, and she went out to do her daily activities. And then I walked home, Sasin to Asok. The key thing is you can walk, you can make forward progress every day. You can get where you want. And that's just a big lesson that I've learned from my mom. Anyways, that's why I try to highlight that we're talking about long term. We aim to deliver reasonable returns with reasonable risks for an unreasonably long time. That's me when I was a kid, a baby. That's me when I came to Thailand, and that's going to be me when I'm 100. Our aim is to create strategies that perform over many decades. My dad retired at 58 and lived to 82. He and my mom had 24 years of a happy retirement. That's them and their retirement. I hired a photographer to take that picture. And mom has now lived comfortably with me for 9 years since dad passed away. And she doesn't have to worry about money. Think about living at least 3 decades after you retire. If you retire at 60, you could live to 90. That's why I say long-term is decades, not years. That's mom and me at El Mercado, one of my favorite and mom's favorite restaurants in Bangkok. And that's mom attending one of the Phenomena events. You may have seen her there. It could actually be that long-term is even over generations. Now, our goal is to deliver steady returns over the long run. We have 3 strategies: the all-weather strategy, which is the red line, the all-weather alpha focus, which is the blue line, and the all-weather inflation guard, which is the much less volatile green line. And looking at 2025, the strategies have performed as expected with AWAF on top. AWS was in the middle, and IG has had the lowest return, but also the lowest volatility. We expect that. In fact, look at the performance for the year. This is only for 12 months. Alpha Focus was up 21.6%. All Weather was up 19.2%. And Inflation Guard was up 10.4%. We blew through our goals of 8% for Alpha Focus, 6% for All Weather Strategy, and 4% for All Weather Inflation Guard. All strategies have had lower volatility than world equity, but of course, world equity can sometimes beat us. Now, you can see incredibly that AWAF and AWS have had higher returns in December than world equity. And that's partially because we can allocate, for instance, into gold or gold miners. And if that does well, we can pick it up there. So it's an incredible performance when you think about it. Now, we mix asset classes rather than hold pure equity to try to avoid a portion of equity market drawdowns. But it can also mean that we miss a portion of market booms, for sure. Now, we revise our strategies every 3 months. We are here at this point in time, and that means that if you want to allocate, you can allocate now, but as you get closer to the next revision, there's no need to allocate at that time. So let's look at all-weather strategy, which gained 1.9%. We're 70% in equity, 5% in bonds, and 25% in gold, and we have 0 weighting in commodities. Now, since inception, the strategy was up about 75%. And that's 31.3% above a 60-40 portfolio. Here we can see that in December, the strategy was up 1.9%, which was 1.5% above the 60-40. Incredible performance in December. Our 25% allocations to gold and emerging markets ex-China outperformed significantly. And China did well too. Our 15% U.S. equity tilt was a drag on performance. Now, the strategy added about 6.7% value compared to 60-40 in 2025. And we can see 2025 for all-weather strategies was 19.2 and 60-40 was 12.4. That's a 6.7% difference. And the strategy beat a 60-40 portfolio in 2024 by 7%. So we've had 2 very good years after a very tough year in 2023. Now, I want to mention to you that this is the time to be very thoughtful and very careful. I always say to to everybody is, you love me now because I did well, but you're not going to love me next year, this year, later when I underperform. I really want to reinforce that we celebrate our good times, but we also have to be prepared for bad times. And bad times can come, and they usually come after good times. So yeah, it looks great for the US, and I think our portfolio is positioned pretty well, and we're ready for it. But that kind of return that we just had in 2025, you're not always going to get. So be very careful and think to yourself, you know, the market can go down. All asset classes can go down. You can be in a situation where nothing's performing right. And it's at that point that my hope is that you see our methodology, see the strength that we have, and that you don't panic during that down time, because it's really more important in the long run to not panic and pull out money at the down cycle. So, yes. So let's continue on. I'm going to go back into my presentation. Now, All Weather Alpha Focus gained 1.2% in December. Now we're 93% equity, 3% bonds, and 4% in gold. And also, it's important to see that in the equity section, we're holding precious metals miners at 20%. So though we're not in gold specifically, we only have 4% directly in gold, we have gold exposure for another 20%. So since inception, the strategy was up 23.1% and 15.2% above a 60-40 portfolio. Again, see the notes at the bottom. This is based upon after fees as best we can calculate it. And 1% below world equity, but with a lot less volatility. You can see the green line world equity there overlaid. And in December 2025, the strategy was 1.2%, which was 0.8% above the 60-40 portfolio. And our 20% tilt to precious metal miners and 4% in gold drove that performance. So again, great that we had that in the portfolio. Our 22% tilts to Latin America and Vietnam were a drag, although I wouldn't say they were a huge drag compared to what we gained on the miners. Now, the strategy added 9.1% value compared to a 60-40 portfolio in 2025. And the strategy beat 60-40 by about 3.7% in 2024. Now, let's talk about all-weather inflation guard, which gained 0.4%. Equity is at 25%, bonds at 65%, and 10% in gold. Remember, with inflation guard, we're not trying to have a huge equity exposure. We're having more bond exposure. Since inception, the strategy was up 18.4% and 8.5% above a 40% equity, 60% debt portfolio. The strategy has also experienced less volatility. Here we can see that in December, the strategy was up 0.4%, which was 0.2% above the 40-60. Our tilts to gold and infotech did great. So tips outperform global bonds also, we can see. And global bonds did poorly and was the only fund that lost money in December. Now, when we're talking about the fees, I'll just mention that we make our best estimates of the fees, but one of the things that we cannot really fully account for is sales charges like front-end fees, but all the other fees that we can estimate, we include. So the strategy added 0.4% value compared to a 40-60 portfolio in 2025. And it beat a 40-60 portfolio by 1% in 2024. So I'm going to mention that feel free to ask any questions that you may have. Happy New Year, Krap Ajan. I love my AWS. And My AWS port just changed from 500K to 600K today. That's fantastic. Stay focused, contributing, letting it grow. That's the key. Now, if you have any questions, feel free to let me know and just type your questions in the chat and I'll be sure to answer them. Let me go back to the presentation and I'm going to talk about allocations. So now, my global asset allocations have a high conviction tilt for what I call a multipolar world. What we're doing is not market cap weighting. As you can see, sometimes we go way beyond market cap weighting. For instance, in a typical portfolio, gold is very, very small, but we can have it as high as 25%. So it's not a traditional 60-40 portfolio. Even though we may refer to it 60-40 as a benchmark, that's just because 60-40 is a traditional benchmark. And it's kind of a no-brainer. And it's built around deliberate global tilts where we tilt the allocations towards sectors, countries, or the like that we see are doing well or they look attractive. And it's based upon structural macro beliefs that are driven by our FVMR methodology. Now, here's how my 2026 global asset allocation can be seen in our current AWS target allocations. You can see the detail there. And there's three defining tilts here. One is overweight emerging markets ex-China. The second is underweight U.S. equities. And the third is gold replaces bonds as the primary hedge. These are the three themes that are in the strategy for 2026. We're positioned for those. And if things go well, those are going to go well. So remember these three themes. The first one, overweight emerging markets ex-China. Growth leadership broadens beyond U.S. and China. And demographics can favor Latin America, India, and Southeast Asia. Supply chains diversify and relocate. Think about Vietnam benefiting so much from the trade war between China and the U.S. And we avoid China-specific policy and capital risks right now until we see something more clear coming out of China. Now, a weak U.S. dollar supports emerging markets, and we can see there's been weakness and then a flat level for the US dollar index, and we've seen the emerging markets starting to fly. Now, with Trump's tariffs and rising government debt in the US and weaker US economic data, the US dollar could weaken further. Also, through semiconductors, emerging Asia benefits from AI, EV, and tech optimism. Korea and Taiwan are the largest constituents, and they account for more than 40% in the emerging market ex-China fund that we use. They also are the largest manufacturers of semiconductors globally. Now, I decided to do something kind of fun today, and I thought I would say, who agrees with me out of some of the top strategists in the world? And the first person is Ruchir Sharma. And he's a global investor focused on long-term emerging market cycles. He thinks that emerging market leadership shifts beyond the US and even China. He's particularly interested in India. He has a saying called the one stock market. He claims that the US economy and markets are dangerously narrow, driven primarily by AI-linked mega caps. And he's concerned. So he would say, yeah, go overweight emerging markets. Luke Groman, who was a guest on my podcast, also agrees. He's an independent macro analyst, and he sees real economy growth favoring non-U.S. He's very concerned about the slowdown in the U.S. Stephen Roach, who is a very long-term and famous strategist from Morgan Stanley, has his statement of the end of Chinese exceptionalism, where he warns that China's growth model is broken by demographics, debt, and weak consumption. He also agrees. But who disagrees? You know, let's look at the opposite side of our theme. We could be wrong. Michael Pettis, He's an economist focused on China's development model. China is too systematically important to exclude. And he calls it the cost of exorbitant privilege. He argues that China's imbalances are policy-driven and solvable through income redistribution. So he is not for going underweight China. Now, theme number 2 is underweight U.S. equities, and very few people have this theme playing out. U.S. exceptionalism moderates, but it doesn't collapse. I'm not talking about the U.S. collapsing, but ultimately it could be weakening. And capital and earnings growth broaden globally. It's really been the U.S. that has captured all the growth and captured money into the markets. But part of what I'm saying is that we're not underweight equities, we're underweight U.S. equities. And that means even if the U.S. was to go up, it's likely that other markets would also go up. So we're not going to miss the equity exposure. U.S. equity concentration risk is super high now with the level of small number of companies that constitute the whole market. And the valuation gap matters over time. Now, this is an important one. I want to talk to you briefly about this because it's something that's really critical to me. And that is, remember, our methodology is FVMR, fundamentals, valuation, momentum, and risk. The reason why we use those 4 factors is Sonsek and I and Alex also have been testing and discussing these factors for many years. And one of the things that you can say is that valuation matters. Valuation matters. And the point is that when you buy stocks or a market at a very high valuation, you definitely run the risk that you're not going to get returns. So again, we're not trying to be underweight equity. We're just underweight the most expensive equity. We're also not zero in the U.S. If the U.S. is 60%, we're about 40% on average to the U.S. through our exposure directly and through our exposure through our global equity fund. So from that perspective, I just want to highlight that valuation matters. And ABB says, yeah, Trump disagrees. MAGA, yes. And Trump is trying. And I think this is the reason why you don't go, zero on the U.S. We still have a relatively high, position in the U.S., 25% plus 60% of the global equity that we have. So the other question, there you go, are we in World War III? Well, I would say World War 2.5 was already done, and that was the U.S. taking over Europe. And basically that happened under the Biden administration. By doing that, the U.S. is in now an extremely strong position. By taking on Venezuela, as we just saw, what happened in Venezuela from the U.S., now they're pushing back China, Russia, and any other adversaries. And you could argue that this may slow down the march towards World War III. So the answer to the question is, are we in World War III? I would say no, we're not in World War III. Okay, so let's now continue. And let's dig into this underweight U.S. equities. U.S. equity trades significantly above the other top 5 global equity markets. Look at that, 39 times the CAPE ratio. So it's a long-term and inflation-adjusted ratio, PE ratio. And let's look at someone who agrees with this. This would be Lynn Alden. She's an independent strategist focused on fiscal and balance sheet risks, and she's been looking at global rebalancing risks rising, in particular thinking about maybe the U.S. is not the best place to be. She's talking about fiscal dominance, and she argues that in a regime where government spending and debt servicing dominate monetary policy, it's overpowering the Fed, and there's not much that the U.S. government can do. Another one is Russell Napier. Russell worked at CLSA for a long time, where I used to work, and he's a financial historian focused on financial repression. And he says U.S.-centric models weaken over time, and when he talks about financial repression, he warns that governments will force savings into low-yield assets through regulations to manage debt burden. This is a really, really interesting theme, and it's a reason not to have too much exposure to the US. And I want to talk about this theme for a little bit because I think it's such a fascinating theme. So when we look at this concept, the problem that we face, that the US faces, is that Trump is going to use the Fed to lower the rate as fast and as hard as he can because he needs it for the midterm elections in November. And so this is critical. But the question is lowering the interest rate on the Fed funds rate going to lower the interest rate on the long-term bonds? And the answer is probably not, because people will say, well, when Trump lowers interest rates, it's going to cause inflation to rev up, and I need to be compensated for inflation, and therefore I'm not going to, I need a high yield on my long-term bonds. And therefore, what happens is that the interest cost to the U.S. government doesn't go down, even though the Fed's bringing down interest rates. And so part of what this financial repression idea that Russell Napier is talking about, and some others have talked about, is the idea of basically forcing companies, banks, countries to hold the bonds of the U.S. government, and not at, let's say, 4%, but say, no, we're only going to pay 2%, or we're only going to pay 1%. And the U.S. government could force banks, in particular, insurance companies, others, and say, you have to hold these, and we're not going to pay more than 1 or 2%. This is not free market. It is repression, but that is a possibility, right? So let's continue on. And I want to go back to the presentation. Let's see. Hold on. So that's a little bit about this idea of financial repression. And part of the argument could be don't hold U.S. equities or U.S. dollar. Now, who disagrees and says, no, this is bad. You want to overweight U.S. equities? Tom Lee, he's an equity strategist and co-founder of Fundstrat. And he says U.S. equity bull is driven by earnings and AI, and that U.S. equities remain dominant. And I think this is something that can go wrong with our strategy, right? If we think about what could go wrong with our strategy, we could go wrong in the sense that we could be negative on the U.S. and the U.S. could fly. So part of the benefit of going through and looking at different strategists, different ideas, and opposing ideas is to think what could go wrong. So we understand our positioning. Our positioning is slightly underweight the U.S., and the result of that is that we would underperform if the U.S. outperform. A question we got, what is your point of view on gold, please? Jan Keen. Yeah, so we've had gold at maximum 25%. That's our maximum in the all-weather strategy for, I think, about a year or so now. And we are very positive on gold up to this point. Now, remember, we rebalance our portfolio every 3 months. So the next rebalance, that could change. But we've generally been very positive on gold. Kit Crop says, what's your view on India this year? My view is negative right now on India. And although we have emerging market exposure, what you'll also see is that we don't have India as a separate market in our allocations. So I would say the idea probably for India right now is probably neutral. That's where I would say, but we don't have that heavy position in India right now. All right, let's go back to the strategy. That was Tom Lee. And we have others, of course, that disagree. Ed Yardini, he's a veteran strategist. He's been around for so long. I remember since I started. And he says U.S. leadership persists, and he calls it the roaring 220s. And he argues that AI is a productivity revolution that offsets labor shortages, echoing the gains of the 1920s, which was a fantastic time in the U.S. markets. So the third and final theme is gold as a primary hedge. Fiscal dominance limits central bank independence. Basically, central bank is running out of options. And bonds no longer hedge equity risks reliably right now. And gold is a non-liability asset. It is just an asset. Gold does not rely on policy credibility of any government or anything like that. And Trump will do anything to reduce interest rates before the U.S. November midterm elections. Now, consensus sees that the Fed funds will be at 3.2% by November of 2026. That's a very small fall. I expect that to be closer to 1%. I think that Trump is going to do everything he can to bring down interest rates, and that's why he's trying to get rid of Powell. My estimate is that the interest rate's going to go from 3.7 or so down to 2 and then down to 1. Interest now equals 14% of federal government spending, which the government pays about a 2.6% average rate on. And at about $970 billion, interest spending now rivals Medicare and defense and exceeds Medicaid. So we have high and rising government debt, not only in the US, but also in China. So with so much debt, it drives the price of gold. The world's two largest economies are highly, highly indebted. And rising government debt raises concern about credit quality also. And also about the concept of repression, where they force institutions to take a lower rate on long-term bonds. Now, central banks have loaded up on gold and have been generally switching from US dollar. And we expect central bank demand to remain strong. And I think gold can keep up its momentum. It's been pretty strong. We like to keep gold as insurance. And remember that momentum is what we track in the FVMR strategy or methodology or framework. The M stands for momentum. Now, let's see who agrees with this. Gold is a primary hedge. Jim Grant, he's a financial historian focused on sound money, and he's been famous for Grant's interest rate observer, which he's had for many, many decades. He sees gold as a monetary asset, and he talks about the return to tangible assets. He predicts capital will rotate from paper claims into real assets, commodities, and hard money. And so he's seeing that ultimately gold will benefit because of the collapse of paper money. And Luke is back again, and he agrees. He sees a shift away from the petrodollar. He argues that the global system is moving away from the dollar-based energy settlement towards gold as a neutral collateral, not just as a store of value. So gold is going to be a collateral that people can hold and basically use that to pay. And then there's Zoltan Pozsar, and he's the founder and CEO of Ex Uno Pluris, a macro advisory firm in Hungary, and he's formerly from Credit Suisse. He talks about the multipolar monetary system favoring gold. He calls it Bretton Woods 3, which argues the world is shifting from debt-based inside money towards commodity-backed outside money, and the commodity is gold. Now, who disagrees with this? Lacey Hunt, a very smart guy. I like to listen to him on Macro Voices. He's a veteran economist and fixed income strategist, and he says bonds are the ultimate hedge, not gold, bonds. In fact, when things go right, bonds can go up when stock markets go down. He sees a huge debt overhang, and he argues that excessive debt suppresses velocity and demand, and that's leading to long-term disinflation or deflation. Think about that statement there. Think about Thailand. When you look at that statement, argues excessive debt suppresses velocity and demand, leading to long-term disinflation. I'd like to talk about that for a moment in relation to Thailand. This is exactly what's happening in Thailand. Thai consumers borrowed a huge amount of money over a long period of time, and now they're in debt, as we say, up to their necks or up to their ears in debt. They have so much debt that they have brought forward all kinds of spending they could have done this year, next year, last year. They brought it forward to 5 or 10 years ago, and they did all their spending at once, and now they're in debt. And so that suppresses their ability to spend. So part of the big problem that Thailand is facing is that consumers have no power to drive the economy because all of their money has been spent already and they have to repay their debt. So this is that concept. Chuck Bay says, what is your perspective on AI during these 5 years? Well, Chuck, I'm not sure if you want to hear mine because mine's a little bit extreme, but I just think that AI is going to be terrible for the world and terrible for children. And it's going to be terrible for the world because I think it will lead to an incredible amount of destruction. And the power of AI is so strong, and humans are not good in their nature. You know, plenty of people do bad things. So I'm very concerned about AI in that space. The second thing, as I tell my friends who have kids, is don't ever let your child use AI. Ever. It will destroy their brain. It's one of these new technologies that's actually much more damaging than most people think. Just go back to when we got our smartphones. Remember when we used to have flip phones and those kind of basic type of phones, and then we got smartphones. It's going to be smart. It's going to bring us so much benefit. But we didn't realize that 100% of people using smartphones were going to be addicted to them. Now, what people aren't realizing is that relying on AI to do your work causes you to use your brain less. And when you use your brain less, it underdevelops. So I would say from an investment perspective, AI is fantastic because it's hard to stop. And I would say that the winners in AI is Google is the perfect winner because ultimately they have a platform. They can distribute the price of AI tools to their platform. ChatGPT is not in a great position, and they really need to partner, in my opinion. They need to be acquired by a platform, a company that already has many, many millions, if not billions, of followers, or customers. So I would say we'll see a consolidation of AI, and we'll see some fancy startups, but ultimately they're going to be consumed by platform companies that are going to then offset the cost of AI with their others. Lee, also have a positive outlook for gold and believe momentum could continue. Yeah, I think you know, every time we go to our rebalance, I think, what's going to happen with gold? But yep, momentum stays. So I think part of it's a lot of geopolitical, concern. Plus, also another thing that's interesting about gold, Lee, is that it's not a traditional asset that traditional fund managers have in their portfolios. It was never recommended as something to own for traditional advisors for many, many years. In fact, if 5 years ago you would have asked me about gold, I would say, well, gold hasn't outperformed over the last 30 to 50 years relative to equity. But then we had this huge run in gold, and now you have a lot of people that would have never bought gold now trying to figure out how to buy it, how to put it in a portfolio, advisors thinking, how do we put this in a portfolio? So I think that can add to the momentum in gold, and it goes further than what we think. Polypo says, if I buy AWS and AWS RMF, is the difference mainly tax? Yes. There's some small differences because we can't perfectly match them, but for our purposes, yes. The only major difference is tax benefit. Venezuela's seizure of oil will drive oil price down or up. Yeah, this is an interesting one, Maxidius. I think that Venezuela is not the thing to look at when you think about oil price. The thing to look at is the November election. The November election, Trump is likely to lose control of the House of Representatives in the US. It's highly likely because almost every incumbent president loses seats in the House in their midterms. Now, the way that Biden held on to his seats is he released the Strategic Petroleum Reserve in a massive amount into the market, which drove down oil prices. And he did it early enough that it caused that to flow through the whole economy and bring down prices. So I think that Trump is going to do everything he can to bring down oil prices. And if that means making announcements of production related to the Venezuelan oil or deals that have been done by oil companies, he's going to have to signal to the world that oil abundance, the age of oil abundance, is here. And that could drive down oil prices dramatically. Now, I think that oil is an interesting one because it's been driven down so much, but I wouldn't buy it right now. But I would say over the next 6 to 12 months, oil's actually going to look interesting. Next one is, do you think Bitcoin will go up in 2026? That's a good question. I think that Bitcoin is an interesting one. We don't have it in the portfolio, and I don't have a super strong view. But it was really interesting to see the quantum computing stuff coming along, and that kind of came out of nowhere. That is it possible that quantum computing can crack the Bitcoin code? I don't know about that, but we'll see. I don't have a good forecast for Bitcoin, unfortunately. What I can say is it's going to go up and down and up and down and up and down throughout the year, but where it's going to end the year, I don't know. What will happen to the economy if Trump attacks Greenland? Trump's not going to attack Greenland. He doesn't need to attack Greenland. He's going to do a deal with Greenland. And he's going to do a deal with Denmark ultimately. And it's not really up to Greenland in a sense that Denmark is the controlling force for Greenland. So what's going to happen is that Trump is going to love Greenland, and he's going to take care of the people on Greenland, and he's going to welcome into the United States these people. He's going to probably fly there. You could imagine him going there with U.S. passports for everybody that is in Greenland. In fact, if you want a U.S. passport, maybe that's a good thing to do, is move to Greenland and then anticipate this happening. But Trump's going to love Greenland, and he's not going to mistreat Greenland, in my opinion. What he is going to mistreat is Denmark. And Denmark is the body that he's going to either take or deal with, and he's going to make an offer to them, and we'll see how that goes. So that's how I would see Greenland. Keep your questions coming. I'm going to continue to go through the presentation. We've got about 15 minutes more, so hang on, and remember, ask as many questions as you would like. Let's go back into the presentation. I was talking about this idea of, the suppression of demand, right? The suppression of demand in Thailand. Well, we can see that in America, according to Lacey Hunt. Jeffrey Gundlach, who is founder of Double Line Capital, and he's also known as the Bond King. He's such a famous guy in the space of bonds. And he says bonds are attractive again. And he also has been warning, and a few people have been warning about this hidden risk in private credit. They warn that private credit markets, so this is a debt market ultimately, conceal losses due to the absence of mark-to-market pricing. In other words, these private credit funds are buying debt from companies out there that aren't traded in the market, and so we don't see the price. Danielle DiMartino Booth, who was a guest on my podcast, disagrees as gold as a primary hedge. She's formerly from the Fed. She's focused on recession risk, and she says quality bonds are preferred. She says the silent recession is something she's been talking about, and that argues that white-collar professionals are already in recession despite strong headline employment data. So she is negative on the U.S. at this point. Now, what could go wrong with this portfolio? You've seen our 3 strategy tilts. First, U.S. equity dominance could reassert itself. AI productivity remains uniquely U.S.-led, and capital continues concentrating in U.S. markets. And bonds regain their hedging role, right? Inflation falls and stays low, and rate cuts restore negative stock bond correlations. Also, emerging market ex-China growth could disappoint. We're heavily overweight emerging markets ex-China. Political risks undermines investor confidence. Currency weakness could offset local earnings growth. You have to be very careful in these emerging markets, like in Latin America, Brazil, stuff like that. You can be facing some real currency weakness that can drive it down. And gold could fail as a portfolio hedge. It's already had a huge run. Fiscal discipline could improve. Scott Bessent is the Treasury Secretary who's trying to do everything he can to get the debt in control. And if the Treasury Secretary in the U.S. came up with some strategies to reduce the U.S. debt, that would cause a major change in the situation where gold would not be as necessary as a hedge if you believe that he could accomplish what he's talking about. And we could see in that case a strong dollar driving up, and that means low performance for gold. Now, before we get into the Q&A, the Valuation Masterclass Bootcamp number 24 starts on February 6th. I think it's actually another week, but it starts in February. And the benefits that you can't find anywhere else is you're going to become job ready fast by writing 4 professional valuation reports in 12 weeks. And you're going to learn to think and act like a pro through mentorship from me, a #1 ranked analyst. And you're going to prove that you can deliver under pressure by graduating from an intense boot camp. For those at Phenomena, just use the Phenomena code to get $100 off. Just go to valuationmasterclass.com or scan that QR code. All right, it's Q&A time. Let's look at the questions that you have. Feel free to ask any more questions before we end up wrapping up today's session. Okay, Gryffindor Yim says, what is your opinion comparing between AI winner of US and China? That's a really hard question. You know, I think that is a super hard question. I think in the end, US probably has some geopolitical advantage that it can use its relationships throughout the world to force countries to use its US AI. And China does, you know, they're going to say that China, don't use China AI, they're stealing your data, it's not good, whatever. You can already see how the US has tried to maneuver semiconductor production to the US. So it really comes down to force, in my perspective, when it comes to AI of China versus US. And I think US will probably win, even though China is, you know, moving so fast. Never underestimate what China can accomplish. Okay, Pito Techa. Sawadee Andrew, John Andrew, given recent political tensions and statements by President Trump, what is your assessment of long-term investment outlook for weapons and defense sector? Yeah, well, let me ask you, are you an ESG investor? If you're an ESG investor, would you invest in weapons and defense? This is a question not just for you, but for everybody. I'd like to teach my students to, you know, think carefully about the things that they see. But the answer to this question about ESG and investing, I would say if you care about us, people, society, you wouldn't invest in defense or weapons. Now, I have a little debate with my students to talk about this at Chula, and it helps them, you know, think carefully about it. But yes, we've already seen that weapons and defense, you know, continues to rise. And I suspect that as Europe rebuilds, as America has to restock after supplying Ukraine, that weapons and defense will still do relatively well. I'm late. Please launch open-ended tireless AWS. No, we're not going to do that because we have had such a great partnership with Phenomena. And so what we've done, now we could someday do that, but it would be exclusively through Phenomena. The all-weather strategy is something that I credit a lot to Jet, Bank, Gix, and Yong and the team at Phenomena for coming up to the idea together. We developed it together and marketed it together. And we have a relationship that really is of high trust. So whatever we do, we'll do it with Phenomena. Now, let's look at next question. If you got questions, remember to ask them. How will the economy eventually evolve in a situation of K-shape like this? It's very, this is part of the problem with AI. I think AI is going to be extremely destructive to society and to the economy. And in fact, I just did a YouTube interview for a Thai YouTube channel on Saturday, and they asked me about the future of Thailand, and I said many Thai companies are going to go bust. Many Thai family businesses are going to go bust because it's very hard to be a low-cost producer right now, and you've got to add more and more value, and that is not a core strength right now of many of the family businesses in Thailand. So I think you get what's called a bifurcated or a separated into two parts economy. The big companies that do really well and everything else that struggles along. And that's the reason why I started the Profit Bootcamp, where I help mid-sized family businesses double profit in 12 months, because I know that if you don't fix your problem as a small or mid-sized business, you better be careful, because it is not an easy place to compete right now. Yim, you're welcome, and Happy New Year also. I had a great New Year with a lot of friends coming by, and some of my old students came by. One of them was a highlight from my mom and me, which was Kong. He was a student of mine back in 1998 at Thammasat University, and we've kept in touch over all these years, and he's been cooking a lot and cooking steaks and doing little videos, and I said, please come and cook some of your favorite thing for us. And he came on a Sunday, and he cooked an amazing meal, and we had a great time. And so I've been, seeing also another of my former students, Yipun, who came over the other day, which was fantastic, to catch up and learn what's going on. So I hope that the new year was a good time for you also to catch up with friends, catch up with family, and reconnect with what matters to you. In the case of the all-weather strategy and what we're trying to do, we're trying to build a long-term global diversified strategy that you can rely on over a long period of time. Lee says, appreciate your insights today. It's going to be interesting to see where U.S. interest rates end up. Yeah, my bet is down. My bet is down. Can the U.S. economy statistics be fabricated or misled? Yeah, of course. Wherever there's an opportunity to mislead, government officials usually do mislead. But the scope for that is pretty narrow, because we have so many experts looking at the data outside of the government that, it's hard to sustain that. Thank you for answering. I'm impressed with AWS and AWAF, and launched the AF, RMF, if possible. That's a good one. I know Sonsak and Alex are listening to this, and we'll keep that in mind. That's an interesting one. I appreciate that. For U.S. stocks, should I just focus on specific industries like AI, space, and defense? Yeah, I mean, if you're investing in U.S. stocks, and you're a Thai person that may not have a lot of direct access to U.S. companies and all that, I think you want to be really careful what you do. The simplest way to do that is identify some ETFs. Like in this case, you talk about AI, you talk about space, you talk about defense. If you can find some ETFs in the US market or funds in the Thai market, and focus on building a portfolio of that. Now, let's take defense as a sector. If you were to buy, for instance, a S&P 500 ETF, you're going to have some exposure to defense, right? Maybe let's just say 15% is going to be in defense. So if you decide, okay, I want to own the US, then own this S&P 500, and then put an additional small amount into defense to increase into a defense ETF to increase your exposure to defense. But I would not, as an individual investor, I would be very careful about trying to make very narrow bets. Remember, global, right? Long-term and diversified. The key to the success of AWS is diversification, right? And what's your perspective for investing in mining or direct gold, silver, or only speculator? Well, I would say in the all-weather alpha focus strategy, we have gold, mining companies in there, and they've done very well. And I would just say that gold mining companies are very volatile. They can sometimes not behave the way that you thought they would, so you can lose a lot on them too. I would be interested to see how successful we've been in our precious metal miners stocks, because I think it's maybe a little bit of outperformance. So just be very careful about those. If you want to be really careful, then you just go with gold as an example. Yeah, Eastern Europe hasn't, to the extent we don't have Eastern Europe showing up strongly, except in the emerging markets ex-China. And Eastern Europe is a portion of that. It's not a huge portion, but you can say that we have some exposure to that. So many great questions. I want to thank you for all your questions. Just have a couple minutes left, so I'm going to take a moment. My mom has already gone to bed. I heard her just walking in the room. My mom is going to be 88 this year. I'm super excited for that. She's been walking like crazy, and I really want to encourage you. Today I had a meeting, and my driver took my mom and me and her caregiver and dropped me off at Sasin, and then my mom went out. She just got back. I had a meeting at Sasin at 10:30 this morning, and my mom got back home at about 6. So she had a big day out. She went to the park, she walked. But one of the things I've learned from my mom is that you can just keep moving forward. And I walked home from Sasin to Asok today, easy, no problem, because I just thought, just put one foot in front of the other. And that's part of a lesson in life, but it's also a lesson for our health. That's an important lesson. Let's see. How about the Vietnam economy? Will it grow well in this year or next? I think the Vietnam economy should have a pretty good time. I mean, they've got an opportunity to capture all of this demand that U.S. companies in particular don't want to send to China. And so I think that they've got plenty of opportunity to growth. I wish that Thailand could capture some of this, but it seems like it's very hard for Thailand to capture it. Now, will the stock market in Vietnam do well? That's a good question, and we'll see where that one ends up. Yep. All right. Wish you all the best. And your mom, Happy New Year to all of you guys. Happy New Year to Pusha Cha, and Happy New Year to everybody. Thank you for trusting me and Alex and Sonsa. We've done the best that we can. Remember, we had a great year, and that means prepare for a down year. But the good news is we have 4 different asset classes: stocks, bonds, commodities, and gold. And that allows us to prevent the downside from being too bad compared to equity. So thank you all for joining tonight, and I look forward to talking to you again in about a month or seeing you live in Bangkok next week. Take care.